Well, I mean, what I'd seen, once the interest rates spiked for the clients that I did have, in the winter, and there wasn't a lot, we were getting significantly under asking for those times, and we were getting everything we wanted at our inspection. Now, as people are getting more comfortable with these rates, I will say that, I said maybe like a month or two ago, I haven't written an offer over asking in 6 months. And that's definitely not true now. I've definitely written over asking.
So in the last, few weeks, last month or two, you've been writing more over asking and more multiple offer situations.
Yes, more multiple offer situations, a little bit more bidding wars. Like I said, the sellers are. I don't think it ever really turned away from the seller's market. I think even when those high interest rates, like it was still technically considered a
no supply, right?
Yeah, exactly.
There's just not enough.
Hey guys, welcome to the Realized Gains podcast. We're on episode 32. I'm Stephen Tran. I'm an Oregon realtor, and I'm a multifamily and short-term rental investor.
And I'm your co-host, Jordan Lee, and I invest in single-family homes, and I'm a mortgage lender based here in Portland, and I'm licensed in about 7 states.
Yeah, great. And today we're just going to do a little bit of a market update. We haven't really had a chance to really talk about how the market has changed.
It's end of Q1, right?
Yeah, it's April 6th right now. So, we kind of just wanted to talk about, how we're feeling about the market, some stats, and just, where there are opportunities in this market.
Yeah. So, hey, to get us started, Stephen, why don't you just talk a little bit about kind of activity you're seeing out there? What's your pulse? What's your feel?
Well, I mean, I'm proud to say, I've had a record quarter. I've actually had my best quarter yet. I think,
nice.
In the fall when summer and fall when interest rates were peaking at 7%, I think everybody kind of saw, a little bit of a lull. Like people were scared. They just weren't making moves, looking for better opportunities. And what are interest rates now at?
Yeah, I mean, I just locked a couple clients in on FHA loans in the mid fives at 5 3/8 or 5 5/8. Without points, so I was pretty excited about that. Conventional, we're like, I quoted someone at just under 6 the other day. So I think, we're at that high fives, low sixes now for most programs. I mean, assuming you're in a great credit position.
Yeah, and I mean, we're not in the threes or the the high twos like last January and maybe the year before. We dropped like roughly 1.5%. But I think people are getting used to this market in a sense, and they're starting to make moves. They're starting to realize that
the shock value is down, right?
Yes, exactly.
Yeah, you tell someone your rate it's going to be like 6.25, 6.5. They're not like, oh, screw that. I'll call you next year.
Yeah, I mean, that's the thing. I mean, there's shock value no matter what. If you're at 3% interest, the shock value is I have to pay $100,000 over. I have to go get give up my inspection contingency. I have to not waive an appraisal, but add a huge appraisal gap. Appraisal gap.
Right. Mm-hmm.
So, I mean, what I'd seen, once the interest rates spiked for the clients that I did have, in the winter, and there wasn't a lot, we were getting significantly under asking for those times, and we were getting everything we wanted at our inspection. Now, as people are getting more comfortable with these rates, I will say that, I said maybe like a month or two ago, I haven't written an offer over asking in 6 months. And that's definitely not true now. I've definitely written over asking.
So in the last, few weeks, last month or two, you've been writing more over asking and more multiple offer situations.
Yes, more multiple offer situations, a little bit more bidding wars. Like I said, the sellers are. I don't think it ever really turned away from the seller's market. I think even when those high interest rates, like it was still technically considered a
no supply, right?
Market.
Exactly. There's just not enough supply.
Yeah, and so, I mean, like I said, we're just getting to, I think what I would say is more of a balance, maybe closer to, I mean, like I said, at the end of the day, what the price a listing agent and their seller put it at is their opinion.
Right.
We have to realize that, some people price low to get some traction. It's not actually what the house is worth. So regardless if it's near asking or not, it's like, are we getting the true value for the property?
Right. And we haven't hit the peak season yet, right? It's
Yeah.
still kind of early in the year. We haven't reached summer break where everyone's going to be putting their house in the market. Everyone wants to move. So I think, we'll see a pretty healthy market. What are your thoughts? Do you think we're going to see?
I mean, I was to say this is I hope so, because I had a record winter, so I'm hoping that continues for the next quarter when things get hot, because then that would be really great for my business. So yeah, I mean, like I said, people are real estate is obviously has a lot of seasonality, and nobody wants to move in the winter, in the rain, etc. during the middle of the school year. So I think it's a good time for people to start looking into real estate, because like I said, I'm positive that activity is going to start picking up.
Yeah, and which kind of brings us to the next point. I was looking at values because you see a lot of headlines in the news that they're pretty negative on home values and real estate overall as an investment, just because it sells clicks. That's what people click on because they want to see that. There's a lot of fear, and what I've seen in the looking at Case-Shiller, I look at a few indices. I look at the Case-Shiller CoreLogic Index, which tracks the values of same price of homes over time of the exact same home. And from the peak, the Case-Shiller Index is down 3% from its peak in June. So it's a minor moderation, but already in the last month-over-month report that came out, which was for February, it increased 0.8% in the month of February, which is up 4.4% year over year. So even though it moderated a little bit from the peak, values year over year are still up. They're still increasing monthly, even though we had a couple months of minor decline. And that's from Case-Shiller, which is considered kind of the gold standard. And they look at all values. They look at multi-million-dollar homes. They look at values on cash contracts. They look at every address. If you look at the FHFA index, they only compare homes that are with conventional loans.
Yeah.
So that no cash transactions where you're getting theoretically a discount, right? And typically not a $5 million home. You're usually not going to get a $600,000 mortgage on that home, right? It's usually going to be some kind of jumbo mortgage or cash deal. So some of those outliers are taken out, and with that index, it never. I mean, at the peak, it was only 0.6% higher, so it didn't really modulate that much at all. So I think values have remained stable and will continue to, and mostly because of supply. I mean, there's not a lot of supply.
Yeah, that's definitely gonna be true. I mean, how many homes are we short in the U.S.?
Oh man, I mean, I think it's the numbers are out there. I don't have them on hand right now, but we're way underbuilt, and we're not building at any speed that's going to catch up. I mean, unless the government decides to start building a bunch of homes, I think we're going to be tight on supply for a while, and I think we're going to continue to see a support in values. I mean, the foreclosure rate remains at record low at 0.3%, and that's of homes that have loans on them. In the United States, over a third of homes are owned free and clear, which means that of the 2/3 of homes left over, only 0.3% of those are in foreclosure proceedings. So it's really small.
Yeah, and I think, like I said, I think it's definitely over 1 million homes that were short. So, and I did want to talk about a misconception. I know people always look at the Fed rates always going up every quarter. Right, it's up a quarter. Does that mean that rates are going up in accordance? And I definitely would like you to kind of clear that up with our audience.
Totally, yeah. It's interesting because if you have a HELOC like me, I have a couple of HELOCs that I've used for other investments, and because the Fed rate has gone up, my monthly payment on those HELOCs have gone up rather significantly.
Yeah.
And so what the Fed rate determines is the overnight lending rate that banks use to lend to one another, right? So like if I have a bank and I'm low on cash and I need to borrow some money, I'll go to Steven, give him some treasury bonds, and get cash from his bank, and he's going to charge me a premium on that money, and then I'll refund him whatever the next day once I get my deposits back, and that's kind of how the banking world works. So what the Fed does is set that rate, and they've steadily increased it because they want to shrink the supply of money because they're trying to fight inflation. They don't want to have too much inflation. Inflation has been going up, and so the Fed's been raising their interest rate to counteract that. So right now, the Fed rate is between 4.75 and 5%. The Fed fund rate, which makes prime, which HELOC are based on, around 8%. So HELOCs are typically going to be at prime plus a margin somewhere in the 0 to 2% margin, just ballpark. But mortgage rates are under that, and because inflation is shrinking down, because the Fed funds rate increase is causing that inflation, tightening money in the economy. I expect mortgage rates to continue to go down a little bit. They're, like we were saying earlier, right now in the low sixes, high fives, depending on the program. And look, talking about inflation, we hit our peak in June at about 9%. And that's what's from the consumer price index. And that's come down since then. We're closer to 6% now. The Fed has said that their target is 2%, but they kind of walked back a little bit on that.
Yeah.
Anyway, what we're seeing is it's not increasing as rapidly. So inflation, the pace of increase of inflation is coming down. So as that continues to happen, mortgage rates are, tied with inflation. So as inflation goes down, mortgage rates will continue to come down.
Can you explain exactly why inflation affects the mortgage rates specifically?
Yeah, I mean, right, because the Fed fund rate is an overnight lending rate. It's a short-term rate, right? Mm-hmm. And a mortgage rate is a long-term, like usually a 30-year fix, right? So if I'm lending money to a bunch of people and my only source of income is a 30-year fixed return on that, so if I'm getting the same payment for 30 years, if I know inflation is going up, I have to increase my rate, right? Because if inflation is going up, 5% per year, that means I'm going to be able to get, 10 years from now, my monthly payments that I'm receiving on these loans that I'm putting out aren't going to be enough to pay for my bread and my whatever other bills, because those things are going to increase. So the value of my money is going to go down over time. So I have to raise my rates.
Yeah. Okay. That totally makes sense. So let's talk about some interesting things that people are kind of doing now in this market. I know that you were working with Alex on a client that got an assumable loan. Can you talk about what an assumable loan is?
Yeah. So it comes up. An assumable loan is the word assume is like you assume someone else's loan. So you're taking over someone else's loan. And it comes up in a market when rates have come down, when rates have gone up, right? So for example, in the loan that I'm doing right now, the client, the seller has an FHA mortgage, which FHA and VA mortgages are all assumable. But it's up to the servicer whether they want to allow you to do that or not. So not every servicer is going to allow it. But so the seller has an FHA loan at 3.25%. So the buyer is going to assume their loan, and then there's a difference in price. So I think the loan's for around $370, and the price is I think it's like $520 or
you
$5.
mean prices in terms of how much the property is appreciated?
Yeah, the value of the home that they're buying. So the home they're buying is like $550 or something like that. So they need to pay for the gap between the $470,000 mortgage and the $550,000 home. And so that part is when it can get a little bit complicated. If the buyer is just coming in with cash, pretty straightforward. But typically, you're wanting to come in with a smaller down payment. In this case, they're putting down 10%, and then I'm going to help them get a second loan that will help bridge the gap between the two of those. So they'll assume that FHA loan, and then they'll have a small HELOC on top of that.
Yeah. And this is your first assumable loan?
Yeah, this is the first one. So it's a pretty complicated process. Basically, I have to get permission from the seller to work with the servicer to get the assumption process going. Buyer's going to have to do an application for both the assumable loan, because that has to be underwritten. An appraisal will have to be done. And then also we'll have to do their application for their second loan. So it's a little complicated process. The servicer said it might take as many as 60 to 90 days. We'll see how long it ends up actually taking. And so the seller has to be flexible in the sense that, they don't need to sell their home in a 30-day time period or something.
Yeah. I mean, then they got to get that sweet, what is it, 3% rate,
yeah,
or whatever
so
they have.
they're getting a significantly under market rate, and it's already 3 years into the term of the mortgage too, which is kind of cool.
Yeah.
But yeah, I mean, it comes with some some costs, and ultimately though, I think they're going to save about $600 or $700 a month by doing that.
No, that's awesome. I mean, like you said, I know it's your first one, and it is complicated. Is it a fun loan to work on?
I think all loans are fun. It's fun. It's fun to solve problems.
Yeah,
at least the ones that close.
Yeah, that's great. Well, yeah, I mean, I was so saying that's an option. Obviously, that means as a realtor, I have to look, in the notes to see if they're even offering an assumable option.
Yeah, as a buyer's agent, right?
Yeah.
Check out whether it's an option. As a seller, talk with your clients, see what kind of loan they have. Do they have it? I mean, it is public record. You can go to the title company and look up on the title report if it's an FHA or VA loan. And then what you'll have to do is have the seller call the servicer and be like, hey, would you guys allow an assumption on this loan? About how long it would take? And then also, would they allow a second loan on top of it if needed? And then you could market it that way. And theoretically, it could add some value to your listing if it was a very competitive listing and you had a buyer that wanted to buy an under market rate mortgage. But you might have to be a little bit flexible with the timing of your close.
Yeah. I mean, like I said, I pulled up this list for one of my clients that ended up buying something that wasn't an assumable loan. But I can pull up that list, and oftentimes, as I've talked to some of these agents who have clients who have assumable loans, they don't even know that they can do this. Right. So I have to convince them of that situation. Obviously, I haven't gotten an assumable loan all the way through, but like I said, sometimes it's not advertised. You have to have that list. They have to cross-reference it also with what is actually on the market, because they gave me a list of assumable loans. The title company can do that. Doesn't mean it's on the market.
Right.
So that makes it even tougher. Like you've said, if you're an agent, it's going to take some time. They're gonna the title company and whoever's running their data has to kind of cross-reference that information. So just letting you know, can be tough, and I haven't done one yet, but
we'll see if this one's closed. I think it will.
Yeah. It sounds like it's going okay.
Yeah.
Everybody's in agreement. I don't know what the downfalls are. I mean, 90 days, a lot of things can go wrong, right?
Yeah, I mean, something can come up. Who knows? I mean, it still has to pass the appraisal.
Yeah.
So what other opportunities are you seeing now in this market, Steven, like compared to, the previous quarter?
Yeah, I mean, like I said, the previous quarter, things were really slow. I think I won basically every offer that I was writing back then. I mean, under asking, because people are dealing with 7.5% rates on their investments, etc. I honestly think things are getting more balanced because the rates have dropped, like you said, to the 5, 6s, range. I'd say if anything, things are like getting closer to if the listing agent has done their homework, closer to the actual value of the property. I think that's an opportunity. I don't feel like we're drastically overpaying. I don't think we're underpaying. We're just kind of at an even balance point. I kind of feel that way regardless. Like I said, when those interest rates are really low, we're writing ridiculous offers way over asking. I mean, how do those people feel now? If they were to get their house, appraised, I don't think they'd feel pretty good about that. They love their payments,
right?
But they might have lost a lot of equity in that point. So I think there's just a good amount of balance now. There are some bidding wars, but they're not the bidding wars of, like I said, last January, where I was writing blind offers against 20 people.
You still get your full inspection period.
Yeah, I have not given. I mean, I'll say this is that some members on my team are writing very competitive offers. And at the end of the day, if you have a competitive house that is really desirable, sometimes you are going to have to do those situations. I think that's the same in any market.
Any market, right? There's always going to be that one product that everyone wants.
But let's just say a standard 3-2 house, that's common everywhere. I think I'm basically getting at value, maybe competing up against 1 or 2 other offers at the time. They're probably staying on the market closer to now 20 to 30 days instead of going off the market like last January when rates were 3% in a weekend, or just I saw it and it's.
So you don't have to rush your offer as much either.
I definitely don't like to rush my offer, but at the end of the day, the opportunity is having a good agent who is on top of that. Making sure if you have the house you have in mind, that they're communicating with the listing agent just in case anything comes in, but you're taking the time to craft a very intelligent, well thought out offer that makes sense for both parties. So I think that's the opportunity. You don't have to rush, but obviously when I say the right agent, I'm talking about me.
That's funny.
The right agent who's gonna, at least keep an eye on a property where it's not going to go pending and off the market without you knowing. Like I said, a lot of our business and the opportunities is the relationships that we build with, our as a buyer's agent with the listing agent.
And you're still finding off-market deals here and there.
Yeah. And honestly, finding off-market deals is about the connections that you have.
Right.
If you're on a team, maybe somebody has an opportunity.
If you're in a bigger office, maybe someone in your office.
Yes, exactly. You ask and you find out. I mean, for me, I found off-market duplex from my client that, I thought it was a great value in Vancouver, and I got that from being on an email list for, a real estate investing group.
Oh, nice.
Yeah, and so I just jumped on it and found found a client who I knew was looking for a great deal. So there are opportunities out here that aren't on the MLS. It's just about somebody who's putting their ear down to the ground. You might potentially be able to find something. Yeah.
Brilliant. Okay. Yeah, I think there's some interesting opportunities in the loan world right now, too. I think this year we're going to see a lot more FHA loans. If you haven't heard yet, they lowered the mortgage insurance, the monthly premium on it. So it significantly lowers the payment, especially on larger loans for FHA loans. And also, in comparison to conventional loans, now some of the conventional loan rate hit or modifiers, or we call it in the industry, we call them LLPAs, loan level price adjustments, are impacting consumers at a different level. Like I used to always be in my mind like, okay, if you have a 680 or better FICO score, like, and you're putting 5% down, you're probably going to just want to go conventional because the mortgage insurance and monthly payment overall is going to be less. But now with an FHA loan, I've run scenarios where you're putting 20% down, even without the mortgage insurance on a conventional loan. FHA loan monthly payment is significantly better. So be prepared to see more FHA offers this year, and understand that FHA loan is a great product. There's not any additional fees that the seller has to pay. It can close, you can close in a few weeks, no problem. So just expect those offers to be out there, and expect to see more. Make sure you're doing that comparison, because it could be better than a conventional loan when you don't think it is. The other opportunity I'm seeing in loans now too, first-time home buyers. There's lots of programs, of course, and there's going to be more that's coming out. The administration, local administration, is very focused on first-time home buyers. The federal administration is as well. And if you make less than 100% of the area median income, the AMI, you qualify. Those LLPAs, those rate adjusters I was talking about on a conventional loan, are all waived. So it doesn't matter what your credit score is, doesn't matter what your loan to value is. You'll get the top tier pricing. So that's a huge bonus for you when you're getting qualified for a mortgage. Just make sure when you're working with your loan officer that you have someone that knows how that works and how to price it properly, because it could make a difference of like 0.75% in rate or more when you're pricing things out.
Yeah. And, on that mortgage insurance premium, do you remember what the old rate was and what the new rate is? I think it was like point.
Oh, yeah. So for FHA loans, it used to be 85 basis points when you're putting 3.5% down, and it dropped 30 basis points to 55 basis points for 3.5%. And if you're putting 5% down or more, it's 50. So
okay.
Yeah, so, basically a drop in 30 basis points.
Yeah, I mean, can you put that in real life terms? Like, let's say we had like a $500,000 house that I'm using FHA on. Like, how much would I potentially be saving? Now I'm making him do math.
So
yeah, I mean, you're supposed to just have this off the top of your head right away. So
$500,000 loan amount.
Oops. Sorry as we pause and pull out the calculator, but testing his loan skills.
So, I mean, I think that will be a difference of, a good $150, I think, per month.
Per month? Yeah. I mean, that's huge. That can make a huge difference. So.
Yeah.
Yeah. So, I mean, like I said, it's not a bad time to buy. There's opportunities to get into your first home, and get started in your path of building equity. Like I said, the one thing that I know about real estate investing is that you make your most money, honestly, at the price point you buy your house at. And I wasn't the biggest fan at buying last year at 3% interest rates, even though the payments are low. I don't think I would have gotten into the best price point,
Mm-hmm.
And we have an opportunity where the price point is fair.
Yeah.
I think it's fair to good. Like I said, if you're open to value add properties, there's tons of property out there that you can quickly build tons of equity that we can get at a good price. As long as you put in that sweat equity, the time, and do your research in terms of like, is this a great area for this to grow in value?
Yeah, if you can get the price, $20,000 or $30,000 less than what you were trying to pay for it in last summer.
Yeah.
Like, how long is a 2 or 3% higher interest rate going to take before you make up that $30,000? I mean, that's a lot of money. And,
exactly.
And in that meantime, our rate's going to go down to the point that you can refinance and just be fine. That's debatable. Who knows what's going to happen with that? Probably. Yeah. But ultimately, like you said, you make your money in the actual price that you pay.
Yeah, the price point that you buy the house at for the value that the price point has been set. I think that's your biggest value add. Like I said, if you can afford the payments now at these interest rates, just wait. I think I've heard and like I said, I'm not gonna talk for the mortgage guy, but I'm expecting rates to go down in the next year and a half or so. Like,
yeah, I mean, as inflation continues to go down, if it continues to, we expect mortgage rates to continue to go down. I mean, how low are they going to go back to the twos?
I mean,
doubtful.
Yeah, I don't think they're going to go to the twos, but like, let's just say we drop a whole percentage point. Is it worth refinancing at that point?
Yeah. Typically, it's over 0.5% is usually going to be worth it if you're going to be in your house for a decent amount of time.
Yeah, and would that be enough to cover all the costs?
Well, yeah, and once you get more like a 1% down, then you can start. If the market rate is 1% less, you could take like 0.75% lower rate and then do it at no cost.
Yeah.
Or no cost. Basically work in the cost into the rate, and then that will like hedge your bet so that if rates continue to go down, you could refinance again without feeling bad because it costs like $5,000 to refinance. But if it's worked into the rate, you're still getting that lower rate and not paying for it.
Yeah. So I mean, like I said, this is the opportunity where you get in that decent, fair, even low price point. You refinance, have an even lower payment with a low interest rate. Like, I think that is the best opportunity rather than trying to buy at that low interest rate point. Because like I said, everybody loves a low interest rate.
Yeah, as soon as rate comes down, demand's gonna go up, right? As soon as rates start getting into the fours, people are gonna get psyched, and then everyone's gonna be buying a house, and you're gonna be fighting with everyone again.
I mean, like I said, personally, like I feel the demand regardless, because we know that there's no supply.
Yep.
Houses may be sitting like I said, they're not sitting for 2 days. They may be sitting 20 to 30 days. But I mean, that's still pretty short amount of time.
A short amount of time.
Yeah, I think
it feels long compared to what we've been experienced, but yeah, it's not like a 60-day, 80, 90-day.
I mean, I think there is a period where it was like 6 months was the average.
Mm-hmm.
And I know Alex, our principal broker on my team, has had listings that have sat for 2 years. During like the Great Recession. So. Just understand that 20 to 30 days on the market while while our clients that we list their properties freak out over 20 to 30 days, in context, that is not that long,
Totally.
Yeah. So, I mean, I think that's a great market update for our viewers, just to kind of, understand the market, know that there's opportunity. I mean, honestly, there's opportunity in every market, low interest rate markets, high interest rate markets.
Yep.
I personally like buying in high interest rate markets as long as you can basically withstand, those, the rates, or not the rates, but the payments for the time being. Like I said, you get in at that low price point. Like, I'm an equity guy. I love my equity, and that's where you're going to grow your equity the most, is getting in at that low price point.
Yep, absolutely.
Okay.
Well, thank you so much for tuning in.
All right, thanks, guys.